Tonight we begin with China. The big headline is their economy. Growth is slowing down.
The troubles facing China's real estate industry appear to be just getting started, despite Evergrande's successes in resolving financial issues and averting an official default. Today, we are going to discuss China's real estate crisis, which will affect the global economy. While numerous analysts anticipate that China's challenges will be confined within the country, with the Xi Jinping administration taking measures to control the situation before it adversely affects the banking system, a contrary view has been presented in a recent report. According to UBS, the breakdown in the property market, if it escalates, has the potential to erase $1 trillion from the global market. Despite prevailing opinions that the issue won't lead to a broader worldwide financial contagion, this assessment suggests a significant impact on the global financial landscape if the property market situation worsens. The International Monetary Fund projects a 4.9% global growth next year, but UBS suggests that a distressed Chinese property market could subtract 0.5 percentage points from this growth, as reported by The Telegraph. With the global economy valued at $95 trillion, this figure might double if the crisis escalates, potentially impacting other economies worldwide. According to Jimmy Chang, Chief Investment Officer at Rockefeller Global Family, a significant economic problem in China could lead to contagion affecting the rest of the global economy, emphasizing the interconnected nature of international economic dynamics. Houses are meant for habitation, not speculation, is a phrase that Chinese President Xi Jinping has consistently reiterated over the past 6 years, originally expressing it during his address at the 19th Party Congress in 2017. As Xi prepares to seek approval for an unprecedented third term at the upcoming 20th Party Congress in a few months, his concerns are materializing as a substantial crisis unfolds in China's real estate sector. A 2-decade-long surge in the real estate market, driven by funds from pre-sold homes and increasing debt, has propelled Chinese property into becoming the world's largest single asset class, surpassing an astonishing value of $50 trillion. China limited the amount of loans available to developers in August 2020 in an effort to make them reduce their burden. The so-called 3 red line safeguards prevented some developers from receiving credit, which started a chain reaction of defaults. Since 2020, the wealthiest 9 real estate tycoons have lost $79 billion due to Xi's crackdown on the soaring prices of real estate. Their declining fortunes serve as a metaphor for the crisis that has gripped China's real estate market, which accounts for up to 30% of the nation's GDP and roughly 70% of personal wealth. Chinese developers, including well-known ones like Kaiser Group, Shimao Group, and Sunac China, have defaulted on at least $18 billion in offshore dollar notes and $2.5 billion in onshore debt during the past 1.5 years. Home sales and prices in China have dropped for a record 11 months running as consumer confidence in the real estate sector wanes. Given that pre-sales account for up to 90% of all real estate transactions in China, this has made it more challenging for developers to finance construction. Tens of thousands of purchasers' unwillingness to pay their mortgages for unfinished construction projects is what has made the issue worse. Nomura estimates that between 2013 and 2020, developers pre-sold just approximately 60% of the units that were ultimately delivered. The boycotts may be the biggest mortgage protest in Chinese history, since they have expanded to at least 320 projects across 99 cities in just 2 months. Approximately $5.3 trillion of the $9 trillion that Chinese banks are exposed to comes from mortgage loans. Analysts predict that the boycotts may have an impact on loans totaling up to $291 billion. In contrast to the U.S. subprime mortgage crisis of 2007, many Chinese borrowers are able to make their payments but opt not to, as opposed to money being lent to high-risk borrowers who eventually failed. China has taken steps to assist developers facing financial strain by offering $29 billion in special loans through policy banks. In addition, the country announced an economic stimulus package on Wednesday, earmarking $44 billion that state policy banks can invest in infrastructure projects. Despite these measures, research firm Capital Economics estimates that developers require $444 billion to complete stalled projects. The stimulus packages aim to alleviate pressure on local governments responsible for infrastructure spending. However, the housing crisis has led to a sharp decline in developers' demand for land purchases. Consequently, local governments have experienced a significant 32% drop in income from land sales, a crucial revenue source. While a complete collapse of either China's economy or its banking system seems unlikely, the government-induced bursting of the property bubble is anticipated to lack a smooth landing. In March, for example, 288 newly developed apartments in Shenzhen were swiftly sold online in 8 minutes. Similarly, buyers in Suzhou promptly acquired 400 units. The consequence of such rapid transactions is the emergence of an asset bubble. Concerns among economists have risen, surpassing the scale of the housing bubble witnessed in the United States during the 2000s. To contextualize, at the peak of the U.S. housing boom, investors injected $900 billion in a year. In China, in the year ending in June, investors had poured in approximately $1.4 trillion. While the market did experience a brief slowdown after the coronavirus outbreak, it was just a temporary pause. By June 2020, urban housing prices in China had rebounded, registering a 5% increase year on year. However, the current situation suggests a potential unraveling of this previously resilient market. Beijing is actively working to moderate its housing market, implementing stricter policies to control overbuilding, limit debt, and conserve cash. The government is particularly concerned about preventing a surge in property prices, aligning with its recent Common Prosperity Initiative aimed at addressing inequality, notably in the context of measures taken against internet companies and tuition firms. These regulatory measures have laid bare the vulnerability of Chinese developers who had thrived on a business model centered around debt accumulation for housing construction. Notably, major players like China's Evergrande Group have already faced consequences, defaulting on significant payments, and the repercussions are extending throughout the economy. The government's efforts to cool down the property market could potentially slow China's overall economic growth. This sector constitutes around 1/4 of China's gross domestic product, surpassing its counterpart in the United States. If these regulatory constraints intensify, there is a possibility that China's growth might decrease from the current 6% to a range of 3 to 5% in the coming years, according to a report in the Wall Street Journal. The most significant impact of the crisis has been felt in China's international junk bond market, known for its higher default risk compared to bonds issued by governments and more stable companies. Over the past 6 months, a downturn in this market has resulted in a 1/3 reduction in investors' wealth. As the crisis deepens, companies are expected to exercise control over construction activities, while banks may be reluctant to provide financing as they work to restructure compromised balance sheets. Simultaneously, Chinese households are likely to become more cautious about taking on new mortgages. With household debt surging from $2 trillion to over $10 trillion in the previous year and incomes rising at a slower pace in comparison, households might adopt a more conservative financial stance, especially if the worst-case scenario materializes. Analysts from Oxford Economics anticipate that China's property market decline will likely be contained. However, they underscore the potential for a more severe crash due to evolving demographics, a significant number of unoccupied apartments, and the substantial over-leverage of some major property developers. This situation could trigger a cascading effect among builders, evident in the economy. Experts emphasize that each company expressing an inability to repay debt increases the likelihood of others facing similar challenges, creating a potential domino effect, as noted by Ayush Sonthalia, a portfolio manager specializing in emerging markets, in a discussion with Axios. The economic distress in China has the potential to extend to global markets, particularly in commodities and raw materials through import-export channels. A reduction in demand for construction materials, automobiles, and machinery could be anticipated. Beijing's regulatory actions have not only affected industries, but have also sent shockwaves through the workforce, impacting millions of workers. This has manifested in declining housing sales and a slowdown in construction, subsequently influencing auto and retail sales. Consequently, if China decreases its purchases of steel, the repercussions could extend to impact the global economy more broadly. In a recent financial stability report, the U.S. Federal Reserve highlighted the potential for issues in China's real estate sector to spill over into the U.S. financial system. The report emphasized the size of the Chinese economy and its global interconnectedness. A crunch in the Chinese property market could lead to unemployment, stock market declines, and deflation, thereby affecting global trade channels. The interconnected nature of China with the global economy could result in repercussions for other countries, although the report suggests that a significant fallout is deemed unlikely. While there is a high likelihood of China taking measures to contain the crash, the necessity for prompt action is emphasized to address concerns impacting investor sentiment. That's all about today's video. If you like this video, don't forget to like and subscribe to our channel. Also, press the bell icon to get notified of our upcoming videos. Let us know your opinion in the comment section below.